Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, an emerging growth and venture capital attorney with K&L Gates, LLP. I'm based in San Francisco, California, but I work with clients from all over the world because they frequently come to California and the Bay Area in particular to do business. Welcome. We've got a great event for you tonight. We're going to talk about how to raise seed funding for your startup using safes and convertible notes. And before we get into the material today, I want to go over some information about today's webinar. So first of all, as I mentioned, for those who attended a little bit early, I'm running all of the tech in the background. So if there are any snafus, please forgive me. And also know that I will not be monitoring the chat function. It's just one too many windows. It's already pretty drafty in here. Can't deal with it. But if you do have a question, I encourage you to use the Q&A feature. If you use the Q&A feature, I will check it out. The way that I'd like to handle this is that I would like to basically speak for a little bit, take any on-point questions that come up, speak for a little bit more, answer any questions that are related to what we're talking about. And then we'll do that for about an hour. I'll have at least 30 minutes on the back end if you've got additional questions. And the questions I'll be focused on are those of general applicability, meaning that if you have, if it's going to apply to the group, I'm going to take those. I'm going to focus on that. Fantastic. All right. I see someone has enabled the closed captioning because I was actually about to do that. So terrific. Now, as I mentioned earlier, today's event is recorded. So if you're watching us live, welcome. If you're watching us on a time-shifted basis, welcome again. But the corollary to that is this is not a venue for sharing any confidential information, so please don't do that. Additionally, I think that's it. Again, as I mentioned, we're recording. Additionally, please fill out the audience poll. It's always really helpful to know who's in attendance today. Now, a few important caveats. I wouldn't be much of a lawyer if I did not give you some warnings and caveats. Today's discussion is general information. It's not legal advice. We'll talk about rules. We'll talk about exceptions to the rules. We'll talk about patterns. We'll talk about lots of things that are related to venture capital and what we typically see. But, like most things typical, they don't apply in all cases. So what you would need is to retain a lawyer who's experienced in the space to ascertain all the facts and circumstances and give you the advice you need. So corollary to that is my off-the-cuff answers to your questions should not be taken as being specific or appropriate for you. I'm just not going to get to enough information on that. Same is true if we follow up in an email or something along those lines. Bear that in mind. Also, on a related note to that, my email is jason.gordon@klgates.com. If you'd like to, connect via email, you're welcome to, but you're not a client until we run conflicts and get an engagement agreement in place. And do not provide me with any information that you desire to be confidential, because I got to run conflicts and make sure that I could take that information before you send it to me. Any questions? Use the Q&A. I see we've got even more participants in the room. So please use the audience poll. Love to know who's here. And let's talk about what we're going to talk about. I can talk about that all day. All right. So I'm going to go over my background, why it is that I'm, talking today and presenting tonight, and why you may want to listen to me. But then we'll kind of move right into the heart of the matter, which is focused on raising seed financing using safes or convertible notes. So if you've got a startup, you intend for it to be venture backed, path to get the first few hundred, first thousands to millions is usually through a safe or convertible note. We'll talk about why that is in a minute. We'll talk about considerations for why we do and use these things, and considerations for when you're pitching to investors. So, I think that should be pretty helpful. Sorry, I'm having a little bit of a tech problem here. Somehow my window got all messed up. There we go. We'll talk about the financing options, right? The safes and convertible notes, what's in them, what's kind of different about them. We'll talk about the key considerations when you're thinking about using these convertible notes or safes, which are I'll sometimes refer to collectively as convertible securities. We'll talk about valuation and dilution, because this is the thing that everybody, it scares all entrepreneurs. It's the sort of bugbear in the room, if you will. And we'll start to tease into that material, start to get you comfortable, familiar with it, so you can use it intelligently. That's kind of the goal of all this, is like, let's give you information, let's empower you so that you can use it intelligently. And then we're going to talk about common pitfalls that I see. So this is kind of wrap up when we can talk about, anonymized war stories and other things that you need to watch out for. And then, we'll have some additional Q&A. All right, we've got more people. Let's get some more people to fill out that poll. All right, so I don't have my glasses on in this photo. Hopefully you'll be able to recognize me, but I'm Jason Putnam Gordon. I'm an emerging growth and venture capital attorney. I've been practicing law since 2005, been in the Bay Area since 2007. Venture capital emerging growth company attorney means that I work with startups and venture-backed companies from formation through their financings, through their exits, and I work with investors as they deploy capital into those companies. I love this space. I love the passion of my clients as they bring new ideas and bring them to life. I'm a little bit of an entrepreneur myself. I ran my own boutique law firm focused in this area for about 5.5 years before I migrated to this fantastic platform, K&L Gates, which has got 48 offices on 5 different continents with nearly 2,000 attorneys. We're a fully integrated global law firm. It's fantastic because I work with clients all over the world and I help my clients do business all over the world. And one of my sort of areas of focus is working with entrepreneurs and executives on financings, frequently serve as outside counsel on corporate matters and in exits, so M&A and other exits. Let's find out who's in the room. So I'm going to take a quick water break, do one more request to have those 3 remaining people to fill out the survey. They haven't already, and then I'm going to tell you the results. All right. So I'm sharing it. So we've got a great big contingent from California and the San Francisco Bay Area and the rest of the United States, which is not really a surprise given the time slot that tonight's event is. I will say that, many times we have folks watch us on a time shifted basis, and look forward to those too. Yeah, the folks in Australia probably can see us live. It's probably your morning. So welcome in Australia. Now, let's talk about who's in the room. We've got a strong contingent of first-time entrepreneurs. That is very common. We've got 54%, which honestly, I feel like it usually trends around 40 or 45. So that's great. We've got serial entrepreneurs. Love having you in the room, especially when we would do these in person. I think we're going to get to do one in person very soon again, but oftentimes we're able to tap into that experience, have those folks kind of share what they learned. And, it sort of supports my philosophy and understanding that entrepreneurship really is an amalgam of many skills, which you can improve via learning and by experience. And the serial entrepreneurs really bring that to the table. We've got lots of folks in early stage companies, some folks in growth stage companies. So depending upon where they are, maybe they use safes, maybe they use convertible notes. Safes and convertible notes after you've already done a preferred round is a similar but somewhat a similar endeavor, but it's got a couple twists. We're probably not going to get deep into that today because most of the folks probably won't experience that. But we've also got venture capital investors. We've got angel investors. We've got folks in academia who just want to increase their knowledge, I presume. And so welcome. We're glad to have you here. I'm going to stop sharing the audience poll. We're going to kind of move on. And I want to share with you, there we go, some structural considerations. So there are other talks that I give where we talk about what kind of entity or is common for a US-based venture capital backed company. And I'm not going to bury the lead here. It's typically a Delaware C Corp, not always, okay, but typically a Delaware C Corp. We sort of run a decision matrix on that. Whatever the business is that, whenever someone, an entrepreneur, an executive comes to my office and they say, look, we want to form an entity. What kind of entity should we form? We always run the same matrix, right? Many times we think we know where we're going to go with this, but you run it. Matrix involves taking a look at what the tax impact are going to be of this entity and trying to optimize it, getting liability shields in place and making sure you have protection of those owners' personal assets, not making them personally liable. Ownership structure and equity grants, right? Who's going to be getting equity? How are they going to get equity? Are you going to need to grant equity to your employees, contractors, other service providers? What's a cost-effective way to do that? Capital raising requirements, what does that mean? That means what are your investors going to want? And what we see here and what drives a lot of the decision these days for venture-backed companies are that venture capitalists and venture funds are going to insist that you got a Delaware C Corp. Not always, but probably 9.5 times out of 10, at least in my experience. Management requirements, like who's going to need to have a seat on the board or other various management roles, which what we talk about in the priced round. When we talk about doing a venture capital financing, we talk about how venture capitalists are going to want to have a seat on your board. And so management structure is one thing that we take a look at. We think about your exit strategy, what that looks like. And we also look at the regulatory framework. What kind of business is this? A healthcare business? Is this a financial services business? Because sometimes there are rules around what kinds of entities can be established and who those owners can be. There's always a miscellaneous bucket that we just check on to see if there's anything else that doesn't fit in those categories. But when you run all of it, sort of 9 times out of 10, you're going to end up with the Delaware C Corp. Delaware, people ask, why Delaware? Well, because corporate law is well developed. There's typically the most protection for the directors and officers that, those folks who have seats on the board are going to want to have. The Delaware Chancery is a very distinguished court that hears a lot of business disputes, and also can resolve them relatively quickly. And so all of those pushes, push the investors to sort of lead towards Delaware. I also like Delaware because they've got a great Secretary of State's office, which that's the office that processes a lot of corporate paperwork, charters and amendments and all these things, which in one sense may sound a little pedantic, but in another sense, when you're trying to get a deal done and you got to get something filed before the deal can get done, you want to make sure it can get through. Now, many times we get a question, and if you've got a question, please use the Q&A function. Many times we get the question, well, I've already set myself up for an LLC. Is my life over? And, the answer is your life is not over. There is an opportunity to change, whether it's via a merger or a conversion. It sort of depends on what kind of LLC you have set up in what state, et cetera. But it does add expense, and there can be some complications. Could be existential complications, or many times it's not. So first, don't panic, just get good advice, and you can get that matter resolved. Now, interestingly, I usually also sort of I also would like to share, I'm going to just sort of move it over. And I found this in Wikimedia Commons, but there's a startup financing lifecycle here, which I'm sharing with you all. And it is just basically where the seed stage fits in. And when you think about, or at least that's what I'm going to use it for today. So when we're thinking about the seed stage, we're thinking about, for most startups, when the initial team is getting put together, when the initial product is being built, and maybe you're actually even starting to sell on the market. Maybe you've got a beta out there, or maybe you do actually, get a somewhat first cut product out there. And typically when we're talking about this, we're talking about probably raising, especially in the Bay Area, less than $3 to $5 million outside. And I work with clients on financings all through the US and, through the world, as well as, so long as they've got a sufficient connection to where I am located or where my colleagues in the firm are located. Business is different. Some places it's $1 million is the sort of threshold and crossover from when you're going to be using safes and convertible notes to doing a priced preferred stock round. And we could spend some time talking about what's the difference between a Series Seed price round and a Series A price round, but that's not what today's conversation is about. So we're not gonna go there. But it looks like we got a Q&A question coming in. Let's see if we've got a question. All right. So we've got a question about most favored nation saves. And I'm going to send those, I'm going to kind of kick that to the end till we get to the safe terms. So thank you. And what else do I want to say? If you are interested or focused or curious on kind of unpacking a little bit more why a Delaware corporation and sort of why you would set that up, I put together a resource as well. And it's in beta mode. It's in a kind of a confidential beta, or at least a limited beta mode is maybe a better way to put it. But it's called, the working title of this is Venture Capital Training Camp. I'll kind of show you, I might plug it a couple times if that's okay, but it's no cost, at least for a limited time. And you can see I've got a couple of different modules here from the corporate foundation, which goes over the corporate structure, to safes and convertible notes, and to venture capital financings if you're interested in that. And I can just kind of put a link in the chat, even though I'm not monitoring the chat. Super duper duper. All right. Moving right along. All right, so let's talk about what to think about when you're thinking about talking to investors. Well, first and foremost is compliance with securities laws. That means, building a pre-existing substantial relationship with the investor prior to them investing in your company. Kind of with that on the back end, I think one of the important things is typically, as I always like to do, you're running a sales process. You're going to be, and some people ask me, Jason, how are you qualified to talk about sales processes? And I say, look, I'm not going to talk about sales process and how to actually run a sales process. Sorry, I meant to put the link in the chat. There we go. I'm not qualified to talk about a sales process for your particular company, but I do want to share with you some observations and some pain points. And when I've seen clients run good processes that have been successful and gotten results, and I see other folks not. At the end of the day, investors are people. They've got a job to, if they're a fund, they've got a job to do. And if you're raising sort of early stage seed, a couple $100K, you're probably not actually targeting a fund. You're probably going to be targeting angels. So, it just goes to, look, these are people. They're motivated by different things. Know your audience, find out about them. To give you a little bit of background, if you're talking about going to and pitching a fund, sort of traditional VC fund has got investors in it. Those are limited partners, oftentimes called LPs. Those limited partners expect returns on their capital that they're investing via the fund. And generally the strategy for venture capital funds is to make a lot of, investments, a lot of bets, if you will, understanding that it's high risk, high reward. So there'll be, quite a number of bets that don't pay off. There'll be some that do okay. And then there'll be one or two that basically make all the return that is necessary for their investors to, for those LPs to get the return on the investment that they're seeking. And one of the things about venture capital funds is that usually they will sort of focus, and we could talk a whole bunch on them, but usually they will focus on a particular stage in the life cycle of a company. So usually, early stage, growth stage, late stage, they'll be focused on different things. Many of them will specialize in verticals, although not all of them. So by vertical, I mean like biotech versus consumer packaged goods, CPG, versus space tech versus all of these things. And so they will, I'm going to just kind of close the chat so I don't get distracted. So you got to know your audience. You got to do your research. There's a lot of great resources out there, TechCrunch, Crunchbase. They've usually even have like their own websites that you can check out, see who's in their portfolio, do your homework on them. There are also non-traditional investors like corporate venture capital arms that are out there that are now playing more and more in the early stage. But most of the time, if we're talking about funds or we're talking even about corporate venture capital, if you're just raising a few, if you're raising your initial few $100K, you're probably really focused on angels because many times funds and corporate venture capitalists they don't play that early. There's a bunch of reasons for that, which we can get into later if you want. Send me a Q&A on it, and I'm happy to sort of spend a little bit more time. All right, so we've mentioned angels like probably many times, and I have not even said who these people are, or these entities, I guess you could say. I'm saying entities as a joke. They're usually people, high net worth individuals, hopefully meeting the accredited investor definition under Regulation D here in the US. They've got different, they've got differing motivations. Many times, or most of the time, it is their own money that they're investing. It should be their own money that they're investing. And so for as many reasons as a person could want to invest, that's what's out there. But commonly we see previously successful entrepreneurs who want to go back into the space that they are in and sort of reinvest and reseed. We'll see folks who are motivated, if you will, by a particular thesis or product of a company, right? Like especially in climate tech and energy tech, we see people who want to use their dollars to sort of vote and support the new energy economy. They could in life sciences or biotech, they could be motivated by a particular disease or cause, something along those lines. So, that's who they are. And then you'll sometimes hear terms like bands of angels or, groups of angels. And those are, groups of these angels that sometimes organize themselves to make investments. And that's typically who, if you're on raising a few $100K, up to a few $100K, that's probably who your initial potential investors will be. And again, it's a sales process. So you will probably want to think about finding qualified potential investors, building relationships with them prior to making an ask. And you'll also want to have enough of them so that you have an opportunity and a shot at getting investment from them. Okay. I'm going to take a couple questions and then we're going to move into the kind of what's going on in the convertible securities. Okay. So if you're raising between 4 and 5 million, that's, I would say these days, kind of around the tipping point and threshold. Certainly I think from the company's perspective, well, so I'd say that's the tipping point of the threshold, and we'll get into why you go one way or another in a second. So I want to leave that as a little bit of a cliffhanger. What type of attorney should organize the terms of the safe or friends and family around those seed rounds? Absolutely, an emerging growth and venture capital attorney. Does not need to be me, but somebody who knows this particular space and is focused on this vertical, so they know what is market. That is sort of what you should be expecting to see. And I think that'll become a little bit clearer in the presentation. Let's see, I'm gonna knock out a couple of these. I do apologize for not circulating the link right away, but we got that out there. All right. What are your choices? What's on the menu tonight? That's the question. So if we're talking about convertible securities, which I hope we are, because that's why we're here today. We're talking about either convertible debt or convertible equity. Now, convertible equity has a much more popular name and has been branded basically by Y Combinator called the SAFE. And the SAFE is a very very common instrument. It's evolved a few times over the years, but that's very, very common. I would say typically out here in the Bay Area, when I do Bay Area focused deals on the sort of the early seed set, like the seed stage size up to, honestly, I've seen people use and have been had clients use safes through several $1 million and 5-10 million, et cetera. I've certainly come across that, and we'll talk about why that is in a second, just to keep you hopefully on your seat a little bit longer. Convertible notes are also very common, very popular. We use them all the time, and I will say kind of Midwest style seems to be more convertible note, and also probably East Coast. So I'd say safes are probably most common out on the West Coast, maybe 50-50 in East Coast ish in my experience, and then convertible notes are a bit more common in the Midwest, although all of this is a little bit in flux. Now, one alternative is venture capital rounds, doing a price round like a Series C or a Series A. That's a different presentation, and we'll talk about why we typically see convertible securities right now. So if you've been on your seat, thank you for waiting. Hope not to disappoint you, but let me tell you why we typically end up using convertible securities at this stage. Well, first, the point of the convertible security is to convert into equity, typically that preferred stock, in the future. And there's going to be a discount, like a bonus, basically like a top up to incent the investor to put their money in and invest now, right? The reason why we do this is primarily twofold. It avoids valuing the company. At the end, I've said this before, I'll say it again. At the end of the day, when we're talking about raising money for a company, if we're talking about safes, convertible notes, preferred stock, we're talking about selling a piece of the company. And if you're selling the piece of the company, you got to get a price on it. But a convertible note or safe actually allows you to avoid actually valuing the company at this stage. And the reason why, if you want to kick the can down the road and avoid valuing the company at this stage is because you don't know what it's worth. There's a lot of risk. There's team risk. Is everyone going to be together? Is there there's execution risk. Can this team actually execute on this idea? There might be very well technical risk. Can what their prototype and what they're working on actually be done? Does the technology exist, or will they be able to bring the technology to exist to commercialize? That commercialization risk. There's probably market risk. Are the people who are the consumers, or or whoever the purchasers of this product or service, are they going to like this product or service? Are they going to actually buy it? All that means, in a nutshell, it's very hard to ascertain what the company is going to be valued at. So avoiding valuing it means that if you are the entrepreneur, you don't have to take, or you can kick the can down the road on taking the risk as to whether you sold too much of the company for too little a price, or if you are an investor, conversely, whether you have overpaid for your interest in the company. And I will also say that it is far less expensive than a venture or a price round to do. There's a host of reasons. There's far less to negotiate, in part because there's also like far less diligence typically that is done on these deals. And so they can happen a lot quicker for a lot less money, so that the companies can spend their dollars on product and people. And sadly for me, not lawyers. But the goal, of course, is to have these companies grow and be successful, and everybody does well. So don't cry for me. Convertible securities. Let's talk about them. So the ones that have asterisks, those are the ones that are in convertible notes, not safes. And for the ones that don't have asterisks, well, they're in both. So let's talk about these. So one of the features, a distinguishing feature between a convertible note and a safe, is that a convertible note is debt. That means you got to pay it back, which means there's a maturity date. Yikes. It means there's an interest rate, right? So for example, on your car, if you've ever borrowed money to buy a car, and I've borrowed money to buy a car, you take out a note. It's actually a secured note. So actually, you don't pay the note, they get to take back your car. Unfortunately, I've always been able to pay for my car. And you got to pay that money back. There's a schedule and there's an interest rate, right? So that's debt in a nutshell. A safe, on the other hand, is more like a pre-purchase, if you will, although I'm not sure all the tax folks will agree with me on this. But in concept, you're kind of prepaying for a bit of a discount on the equity you're going to get. Now, a convertible note also has that feature. It has the feature where, when there's a preferred stock financing, it's going to convert all that debt rather than having to repay it in cash, is going to convert all that interest too, most of the time, is going to convert over into equity, into that preferred stock. But there is no debt feature on a safe. So it does not, it does not need to be paid back over at a certain point in time, and there's no interest. Now, each of them will have conversion terms, and we're going to talk about those in a minute. And we'll even do some high-level math for those of you who have the stamina. I got a decent amount of sleep last night, so I can do it. It's got amendment terms. And this is sort of one of the things I put on here that I think is very critical. The old safes, so kind of prior, there are a lot of great things, I think, about the pre-2018 safes. And I can't believe I'm saying that as we are here in 2023. But time marches on. But one thing I never liked was that if you wanted to do an amendment to the safe, you had to go out and get each investor's consent to do that, rather than the holders of a majority and interest in those safes. And you might say, especially even if you're on the investor side, man, what's wrong? What's wrong with having to go to each investor to have to amend the safe or the convertible note, let's say. And let's take the convertible note as a real concrete example, because this is one that people will feel. But there could be times where you need to effect an amendment to that convertible security. And taking the convertible note, for example, where there is a maturity date, let's say you're bumping up against that maturity date and you need more runway, right? Let's say things are actually really coming together, or you're able to raise some more money, but my goodness, you're just not in a position to pay that convertible note back. Well, you go out and get an amendment. And if you had to go out to each and every single investor, there could be an investor or two who did not consent to that amendment. And then you're stuck. And theoretically, depending upon who that person is, they could push you over into involuntary liquidation or bankruptcy. So having a majority of the investors basically be able to go out and effect, with the company's consent, right? An amendment is an important mechanism. Now, there are other times where this comes up, even in safes. Maybe the cap was too low, maybe the discount was too high, or so there are many different reasons, but it's great to have the holders of majority and interest in there. And with respect to safes, it's not super common to negotiate those. Although there are always some tweaks that we build into the safes, even the newer ones. And then with respect to the convertible notes, there is no standard. I'll say it again. with respect to convertible notes, there is no standard. So your attorney and you need to work together very tightly, whether even if you're investor side, your company side, to make sure you understand what you're getting yourself into. Because I'll say it a third time, for convertible notes, there is no standard. And that's also on my pitfall. So there are definitely features that are common to see, and we're going to talk about those right now. But there is no standard. All right, maturity dates. So typically, look, here's what you should be thinking about. If you're running and putting together a convertible note, you should be thinking about, well, when am I going to do my price rounds? I need to be able to hang on the money and use the money, and the company needs to be able to have possession of and be able to use that money for the period to get to the next financing, right? And you need to build in some cushion. Now, I think this is really critical if you're a company, pay attention, like make sure that's real cushion, because if you run out and you can't get an extension, you can get, or you're trying to get a financing done, that can become leverage. It can be leverage that can get used by an investor or investors. And investors, like, make sure that is a real, to the extent you are able to drill into and understand whether or not that's enough runway. I mean, make sure that it is enough runway, because what you don't want is an undercapitalized company that's not going to make it to the next round, right? Because if you do that, then your money is very well probably lost. Now, if you're investors and angels, I mean, one thing you may want to pay attention to, or you should pay attention to, is the California financing law, which applies to persons engaged in the business of a financer, lender, or broker. That sets various sort of limits on the number, potentially on the number of safer convertible note investments convertible note investments that you can make, as well as maybe some interest rate issues. There's a venture capital exception. So usually venture capital funds are not focused on this because there's an exemption for them, but that's something that's out there. And when I say this, California financing law, I'm talking about as a California attorney, right? So, if this raise is happening in Austin, Texas, or it's happening in Missouri, or it's happening, in New York, there are different sort of similar laws. Also very common in convertible notes, because there needs to be an interest rate. It can be as low as the applicable federal rate. Otherwise, there's going to be imputed interest. And that means basically you're going to get taxed because the government's going to take the position, well, there ain't no free money. And what should they have been paying in interest? And California interest rate can be as high as 10%. Although actually, I probably need to update this slide a little bit, because there's two mechanisms to look at. One is the 10% number, but then another is it kind of floats on top of, I don't remember what it is. Maybe it's prime or something like that. But, when interest rates are up as they are moving this way, sometimes you can have a higher interest rate. The takeaway here, whether you're in California or somewhere else, is make sure you're checking on the usury laws. And then the other thing too is, you're going to want to make sure you're checking with, make sure you're tapping in the usury law. The other thing that I wanted to just briefly mention is that, I mean, typically, the interest rates we see here are not super duper high. We see them being sort of commonly 6-8% or something like that. So if you will. And AFR, I said, was the applicable federal rate, right? Conversion terms. All right. So this is kind of like the main terms that you're going to negotiate if you're out there, especially if you're talking about safes. Especially if you're talking about safes and convertible notes. Convertible notes are going to have a bunch of other terms, because for the fifth time, there's like no standard. Although I will tell you, if someone in the startup and venture space, a personal guarantee on a convertible note is unheard of. And if you, at least here, sort of in the US, as sort of domestic kind of custom, it would be unheard of. And if you were to see an investor request or insist on that, then it probably is a signal that that investor is not familiar with the space. And so they may or may not be kind of in your qualified investor bucket, because one of the things that's really important, because investors are people too, is like understanding what their expectations are and making sure you can deliver on them. Now, maybe you will be able to educate that investor and reset their expectations. But you may not be, in which case you don't want to have an investor on your cap table or who's got a, you don't want to have an investor on your cap table that's going to potentially become unhappy for reasons that are not in the circumstances appropriate or would be kind of market or standard, if you will. All right. Enough with all of that. Let's focus on here. Conversion terms. This is really where the nut is, because again, these instruments are really about avoiding the perils of prematurely valuing your company. And it's about trying to set up the right structure to still bring in that investment now. And at the heart of avoiding those perils are the conversion terms, because that's what it's about. It's about taking that money that comes in under the safe or convertible note, and when the time is right, when the event of a preferred stock financing has happened, convert it into preferred stock at a discount to give those investors a reward for the risk they have taken at investing at an earlier stage in your company. Hopefully everyone's getting that. Now, if we're talking about Series Seed, so let's talk about this. So that basically comes down to a couple of definitions. What's the definition of a qualified financing? Like, how do you define this? This is like that sort of preferred stock thing, which I'm talking about. Now, my recollection, I think on the safe side actually is it may just say equity financing. I think it just says equity financing in there. I think the older safes had a number in there, maybe it's 500 or $1 million. I don't remember off the top of my head. But commonly, especially if we're talking about like convertible notes, which we see a lot of, there's some number. And the goal here is so that there's a bona fide, a real financing, right? So you don't have Uncle Harry investing $50 in your company, declaring it to be a $2 billion company. So effectively washing out all those investors or drastically diluting them. And we'll actually probably see why that is in a minute as we work through my math. Another note here is that the discount you choose needs to be reasonable, or else your later investors will not go for it. This is when you need to rely on and be able to effect that amendment provision, which we were talking about before. So, I mean, typically we see 15, 20, 25%, something like that. Don't forget, if you're doing a convertible note, that interest is going to kind of grow and also get converted. So it kind of acts as a little bit of a topper. For investors, that's kind of nice, because sort of the longer that this investment is being made and is hanging out there, you're getting some extra bonus, if you will. Not extra bonus, but you're getting compensated for, for it. Let's talk about conversion price caps, and then in a slide or two, we're going to walk through the math on how they actually work. So the way that we convert basically the principal and interest, or just the safe investment amount, is to determine, first we come up basically with what the conversion price is going to be. So let's just say $1 a share or something like that. And then we divide the the amount of principal and interest that's outstanding by that price. Now, the question is, how do you define that price? On the discount side, if you're using a discount, it's just that discount times what the new money is paying. So if the new money is determined that the value that they are going to pay $1.50 a share, and there's a 25% discount, let's say a 25% discount, my math isn't going to work out. It'd be like $1.05 or something like that a share. That would be the conversion price. If you've got a cap on it, then basically what you do when you're trying to determine the conversion price is you take that cap. Let's just say it's $5 million. You divide it by the number of shares that are outstanding. And that's what the conversion price is. And again, we're going to run through that math in a minute. So bear with me. Sometimes we see conversions used in a couple of other contexts, right? So like a change of control or the sale or liquidation of the company, right? So that's an opportunity for potentially the investors to make sure that they're getting more than just that they're getting adequate compensation and consideration for their investment. And then another, we've talked about one way for convertible notes to deal with the maturity issue. Another way is sometimes there's a conversion mechanism that gets built in there too. Again, sometimes because there's no standard with convertible notes, which makes them interesting. Yep. Okay. Next up. All right. So let's talk about structure briefly. So convertible notes are generally either one or two documents. That's in addition to the corporate authorization that you'll need or want to get, and any side letters. And we'll talk about side letters some more. But we're talking about basically a purchase agreement and the convertible note itself. Or safes, there's usually just one agreement, but not including corporate authorization or side letters in that. Choosing the path. Why convertible securities? Because that's kind of what's market at this stage, as we talked about, sort of sub 5 or so if you're in the Bay Area. Although I've seen convertible notes and safes used at numbers significantly higher than 5 million. And you can also do multiple rounds of these, right? So that's very common to go out and do an initial rounds of, let's say, 500,000 or something. And then you're able to build your initial product or something. And then kind of with that milestone met, that's a great opportunity to go out and, raise additional capital using a safe or convertible note. Avoids valuing the company, which is, very perilous at this stage. And one incidental benefit is that it provides a low fair market value for stock, or it helps support being able to take a position of a low fair market value for your stock or options for when you're granting them to employees and other service providers. So basically kind of typically helps support an optimal tax treatment for them. Downside, convertible debt is debt. It needs to get repaid. And the other thing about debt is that it is an extra liquidation preference, which means basically, if the company is sold or goes under, it gets paid back before the common shareholders do. Preferred stock would also get paid back before the shareholders do. But at the outset, I think I mentioned doing safes or convertible notes after you've already done a price round, and why it's a little bit of a tricky beast. This is one of the issues that pops up there, because usually the preferred investors don't want to have anybody in front of them. All right, let's kind of take this, we'll put it together in some examples. I'm going to use simple, easy math because I'm also kind of doing this off the top of my head. And, we don't need to complicate it and make me get math problems wrong tonight. Nobody wins if we do that. Pre-money valuation. So I want to share with you some terms and educate you on them. Pre-money valuation is the value of the company before the next round of investment. Post-money valuation is the value of the company after the round of investment. So just by using some simple logic here, pre-money plus the investment should equal the post-money. Fully diluted basis basically means all common stock that's issued and outstanding plus any securities or anything else that can be converted or eventually become common stock. Plus, typically the shares that are reserved for equity compensation. Authorized shares is a concept that's in the certificate of incorporation. Those don't usually count when you're talking about fully diluted basis, just sort of these types of things. But you always have to read the fine print in these instruments. I believe in a SAFE, it's called company capitalization, I think is what they use, not fully diluted basis. And you got to read all of these to know what your denominator is. I'm going to share in the chat if you're like really interested in sort of deep diving on some of this. I've got in my pro forma cap table video in venture capital training camp. I walk through Excel sheets. I nerd out on it. Hope you can too if you're interested. All righty. So no Excel sheets tonight. I will spare you. But I'll take some simple math. So let's put this together. So we're not going to take into account any option pool or any other equity incentive plans out there, but let's just say the pre-money of a company was $10 million and that 10 million shares have been split up among 3 founders. Now, these numbers may or may not be correct for your company, but they're nice and round, which makes it for easy math. So this is for illustrative purposes only. That means that founder A has 3,333,333 shares, or roughly 33% of the company. Now, we're going to ignore convertible securities because I want to show you without, and then I'm going to introduce it and show you with in a minute. Sorry, I got distracted by a question. So let's say an investor comes along and wants to put, a new venture fund comes along and they say, because you've gotten your product out there, you've gotten traction. Great. We want to put $3 million into your company. Well, they're going to do that at $1 a share because you're going to take the pre-money, which is $10 million. You're going to divide it by the number of outstanding shares. And that's how you get to that $1 a share. That's how we figure that out in terms of what the new money is paying, that new investor is going to be paying. Now, the post money, incidentally, is 13 million because you take the pre-money, you add the money, and then you got what the post money is. And so you'll see that founder A's shares stayed at 3,333,333 and has roughly 25% of the company because there are now 13 million shares that are outstanding. You've got the 10 million from the original founders and the 3 million that the investors bought, right? They took $3 million divided by $1 a share and they got 3 million shares. Now, I'm going to super simplify this, ignoring, again, equity or option plans. I'm going to ignore some circular math that goes on when you're doing some of these. And the way you handle that, if you don't check out my video on performing cap tables, is you can use the iterative calcs function in Excel, which is a godsend for those who work in this line of work. But ignoring that, just so everyone can kind of follow me. If there had been a convertible security with a 25% discount, and that new investor was still paying $1 a share. So again, we're ignoring the math on how they came up with that dollar, but we're just focused here on understanding how the discount works. If there had been a convertible security or convertible securities with a 25% discount, then you would take the the discount would be 1 minus that 0.25, which is that 25%. So 75% times $1 a share. So that's what they're converting over at. And when you convert $450,000 worth at 75 cents a share, you see that these investors would have gotten 600 shares. Now, they will typically get shadow shares, which usually begs the question, what is a shadow share? A shadow share is basically the same thing that the new money is getting, but there have been some adjustments to reflect the economic differences between those shares. More concretely, the shares converted, the convertible security holders converted over at 75 cents a share. New money's paying $1. So things like liquidation preference has been changed. Things like dividends, that price, anti-dilution, the price at which anti-dilution protections would be triggered would be different. Yeah, I'm not sure dividends are off the top of my head, but anyway, that's the point. Now let's see how a convertible note would work, or a convertible or a SAFE would work if you just had a $5 million cap. So we're not doing the cap and discount SAFE or convertible note, which we have, and we'll kind of combine these in a second. But if there had just been a $5 million cap, but let's say that new money thought it was worth, $10 million, you ignore whatever the new money has valued the company at, right? You ignore that pre-money valuation. You just use that 5 million and you divide it by the number of outstanding shares. So you get 50 cents a share, and you see it when you convert over 450,000 shares, you get 900,000 shares. Now, many times these instruments will combine these two. I'd say that's probably the most common that I've seen, these two features. And then usually the investors will get the better deal. So you'll have to run the math. Should they convert over at the discount, or should they convert over at the cap? Now, one says, well, it's easy. Once the sort of pre-money valuation hits the cap, then you're going to start using the cap. And the answer is really no. It's like you got to divide the cap by the discount, I think. And that's the tipping point on the math. I always run it and double check it. But I will tell you, many a founder and even many investor has been corrected as they've once they've actually run the numbers on it. So it's not just once the pre-money hits the cap, you use the cap. There's some math involved, and it involves the discount. Common pitfalls, non-compliance with securities laws. So, we have not gone in depth on securities laws, but no, they're out there. So securities laws, and I'm speaking focused here in the United States, although they are elsewhere in the world as well, at their heart is sort of investor protection laws. The sort of paragon example is trying to protect widows and orphans from having money, invested in bogus stock, right? But it's more than that. And everybody who sells a security, of which safes and convertible notes will fall into, needs to comply with them. And compliance means, either registering and filing with the SEC, or making sure that you've targeted exemptions both at the federal level and the state level for compliance. So work with your counsel on that. On a sort of subsector to that is paying finders. These are folks who are not registered broker dealers. It's theoretically possible for that to be lawful, but it's pretty narrow exceptions and exemptions. And I will tell you, there are a lot of folks out there who will be happy to sort of pay you to connect them to money. And one of the real pitfalls there is potentially the investor invests under those circumstances, and securities laws aren't complied with. I mean, not only is there potentially criminal liability, although that's probably not the most common scenario unless you're a fraudster, which most people are not. But you may have to offer a right of rescission. That is the right to the investor to get their money back. And if you don't have the money anymore because you have spent it on building your company, you got a problem. Another common pitfall is thinking there are standard terms. I'm sure I've disabused you of that with respect to convertible notes, but even safes, as I've said, they've sort of shift. Side letters are agreements outside of the instruments of the safe or the convertible note that grant additional rights, like information rights to information about the company, maybe rights to have an observer on the board, maybe a right to participate in future financings. They are, in one sense, very common, even in safe and convertible note deals. In another sense, you should be mindful of them because the more side letters you have outstanding, the more difficult it is to comply with them, the more expensive it is to negotiate them at the outset. They are agreements, so you got to follow them. And they can also they can also be problematic for future rounds. So working through that with your counsel is super important. And failure to obtain proper corporate authorization for issuing safes and convertible notes and securities and stock can lead to a lot of expensive corporate cleanup later. And those are a lot of the really common pitfalls I see. We've hit the 7 o'clock mark. I see I've got some questions. Thank you for spending time with me. Let's take some questions. Okay. Oh, this is a great question. Okay. So we've got, and this kind of comes up, and I hope you're still on, but we've got a situation where there is a founder who wants to put more money into that founder's company. And the question is probably, it's like when you set up a company, you're going to, among other things, purchase some stock, and usually, not a lot of money is paid for that. Maybe it's, par value, maybe it's a little bit more than par value. The IP obviously has to get contributed, but then how else do you capitalize this company? And there are a couple different choices. You could buy more common stock. You could take a note for, that is just gets a debt instrument, a basic sort of debt instrument in place, or you could do safe or convertible note. And so I think the question is like, if I want to put more money into a company, should I use a most favored nation safe? And a most favored nation safe basically means, whatever the most favorable terms of the safe that gets granted, prior to a preferred stock round, you're going to get those terms too. You're going to get the best of what anyone else is going to get. I can't answer your question because when I get this question, we look at a couple of things. We look at kind of what's the time horizon that you need to get your money back? How much do you need to put in? What's your overall sort of economic situation? And of course, we talk about the perils of undercapitalizing a company, which means, you don't put enough money into a company, it goes under. Theoretically, you may have personal liability for that. But many times when we sort of run the analysis, it comes down to really kind of one or two things, which would either be some additional debt, which has sort of the advantages of potentially being able to get paid back first or earlier. And, rather than, that's sort of one advantage. But if you got a longer term horizon, then yeah, I usually will suggest you consider, treating yourself at arm's length as another investor. And, MFM may be a great way to go for that. Or if you're trying to maybe even set some precedent or like a psychological sort of anchor of when you go out and do a raise, you may want to consider doing that, right? That way you can go out to those initial investors and say, hey, look, I'm cutting you as good a deal as I got for my money. And so, there's a little bit of positioning, a little bit of psychology. There's taking a look at what your horizon is to when you need the money back, and then also taking a look, or at least getting comfortable and understanding the potential liability exposure on that. So hopefully that's a great question. I've gotten that in practice. I haven't gotten it on a webinar. So thank you. I hope you still answered that, or hope you were still there. All right. Okay. I hope you are too. You've been very patient. You've asked about raising in the range of $4 to $5 million. So typically, at least in the Bay Area, and I don't know where you are, in the Bay Area, that's the sort of tipping point, because the expense of a price round, which is significantly more than the price of a safer convertible note to do, generally speaking, there's enough money being raised that it's kind of worth the investment, if you will. But usually if I'm company side, I will suggest a safe, typically, or a convertible note alternatively. And, you know, because it'll be quick and easy to sort of do, and you avoid valuing the company. But again, that's sort of the tipping point. And again, like, you know, you can have multiple rounds of safes and convertible notes. So, you know, maybe strategically, I don't know, maybe you break that out. Maybe it's, I need $2 million to get to this milestone, in which case I'll be able to, you know, then I'll want to raise another $4 million, but I can set the terms to be more sort of company friendly once I hit this milestone. And so sort of breaking out those milestones against needs for capital injections are something you can do. In terms of notes, in terms of duration of the notes, it says years. Again, one thing about safes is you don't have a maturity date. Typically, we do see, I mean, I would say most commonly 18 to 24 months, sometimes up to 36 months or so. So years would be 1.5 to 2 years, or maybe even up to 36 months. That's what I would sort of typically see. But again, like that's sort of like the rule of thumb. The real analysis that needs to get done is like, what are you going to do with the money to hit the next milestone, to get the next raise, right? And building out that plan is what's critical there. Question about early payment of the note. So I feel like, and I've not actually sort of thought about this in this way before, but this is sort of my, you know, kind of just off the cuff as I think about this. You know, earlier I said, like, if you are a founder and you see an investor ask for a personal guarantee on a note, that's, you know, that would be more or less unheard of, because again, these are about being mechanisms to invest in highly risky startups, right? Untested, potentially startups. And, you know, the goal is to, you know, be able to have the founders take this risk. And they are probably hopefully sufficiently invested, right? Like many, and by, I don't just mean in terms of dollars, but like many times investors will insist founders work full time on it, right? So it may not be dollars, it might be sweats, if you will. The converse is, and I do get this question all the time from companies, and I think it's a really good question. What about being able to pay back the note early, with the goal being, hey, I pay, you know, we're killing it. We're doing a great job, making a lot of money. We can pay back this note. And then when we convert over, I don't have to give these folks equity. I don't get diluted from them. Again, the purpose of these instruments is to incent the investor to take significant risk and pick up, you know, that incentive is picking up sufficient upside. So that is like never done, or to the extent it would be done, it would be in a super narrow, specific set of circumstances. Very, very good question. Very common question, though. So thank you for asking that. All right. And there, I see the person is still here. I'm going to take a quick sip of water. Yeah. Okay. Zooming back, I said, previous question was, I'm a founder of a startup. I want to make, the startup needs additional capital. How is it that I inject that capital into that company? I said, there are really kind of three mechanisms that we typically see. We see additional purchase of common stock. We see, basically a note, an on-demand note many times, like just payable on demand. Or we will see taking a safe or a convertible note. And I mentioned we sort of balance a few things. We've mentioned we sort of balance potential for individual liability against or along with kind of what's the time frame in which you need that money back, or would ideally have that money back, versus kind of potential upside, and sort of on the taking the liability side, and like, let's unpack that a little bit more. So the issue here is if you undercapitalize a business, in particular, sort of when you're starting out and growing it, that is, you don't put enough capital or funds into it, and that can be a blend of, it can be a blend of equity, it can be a blend of debt, and of course, here in the U.S., we don't have any bright line tests. Some countries actually, they require you put like $100,000 into the business. Like, boom, you want a corporation, put $100,000 in the bank account. We don't have that. The issue is here, if you don't, if you as a founder and as management do not put enough capital into the business, then there is the potential that especially if the corporate records aren't, or the corporate structure isn't properly followed, that you could be personally liable if any liability is accrued. Now, what could those be? I was going to say, you don't pay your employees, but there are other ways, there are other laws that actually pierce the corporate veil on that. So that's probably not a good example, but I don't know. Let's just say, if if the business had a car and you ran somebody over or something along those lines, it's possible that you might end up, being personally liable. So that's what I mean when I was talking about liability exposure. I didn't mean like certainty of being repaid. I hope that answers your question. If not, those are great questions. I'd be happy if you want to shoot me an email. I keep office hours. You can, happy to set up a time to just further flesh out my answer. Is there anything you should drop if you change incorporation from Texas to Delaware? Is there a window to structure? Okay. I'm sorry. Bear with me. I know how to read. Is there anything you should do if you change incorporation from Texas to Delaware? Is there a window of time to restructure these companies? Usually sooner is better than later. So there are a couple of things that we'll take a look at. I mean, if it's like really, 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 really early, and maybe it's just the sort of founding team that's working on things, and maybe they don't have any outside contracts or anything. One thing we'd take a look at is like, I don't know, maybe you just scrap that Texas company and start one in Delaware, and you'll be able to, move things over, especially if you haven't actually kind of assign the IP into the Texas company, those types of things, which we see from time to time. I mean, sometimes we see somebody basically file something, never finish any of the rest of the paperwork. It's sort of in this nebulous gray zone. We have a conversation, we can just start a new entity. Other times we got to use a mechanism, either like a conversion or a merger, or basically like an asset deal, transferring the assets over. Usually sooner is less expensive than later. But, the other thing to balance, and this is just me being really practical, is, not only sort of like cost, but also cost in connection with when it's going to palpably or tangibly add value. So, if something's going to be X now, but really all those funds need to get put into the team and other things, and, Y is 2 times later, 2 times or 3 times more later, like if later you're going to have 10 times the amount of capital, even though it's more cost effective to do it earlier, maybe it needs to wait for later. The real X factors, though, that happens on some of these is if you've got folks who can block the deal. And I've definitely seen that before, where there was an LLC or something that was up, and the venture funds want to invest in a C Corp, and that's the sine qua non of it. Without it, it's not getting done. And then you got a disaffected founder out there who has a significant stake, either because they're vested or you didn't get vesting set up, and they block the deal. And they're like, they'll either try and extort. Extort is a pejorative term, but they either try to extract sort of a lot of value from themselves, or they'll just not care, and they're not really incentive to get it done because they're already out. So what you should do is make sure you hire competent counsel, because I've also seen situations where folks have tried to use non-lawyers or maybe lawyers in training to try and do some of these things, and that has not worked out very well at all. And make sure your lawyer's got a corporate background. That's what I would do. And I would work through that. I would think about, what's driving this change? When does it need to get done? When is it going to be adding value? How much is it going to cost now versus then? And bake that into your business plan. I hope that was a helpful answer. Great question, though. Also happy to do an office hours visit to, just talk more generally about what we see in those situations. And same with any of the other folks who are on either live or on a time shifted basis. Again, on these general information calls, this will probably go in at about this level. I don't want to have any confidential information, but always happy to try and be a resource to the startup community, because those are my people. All righty. I see it's a little bit quiet. We've got maybe 12 minutes. I really appreciate the opportunity to present tonight and to share my knowledge with you. So thank you for that. I guess I'll do one more plug for Venture Capital Training Camp. And otherwise, I will let you all get back to your evenings, mornings, afternoons. I guess in some places it's almost the weekend, so I'm a little jealous. Oh, all right. Question about Wyoming. And state taxes. If you are out here doing business in California, you're going to have to pay taxes, whether you got a California taxes, whether you got a Delaware or a Wyoming company. So those are not usually driving questions. I guess if you were in Wyoming, you I guess might want to consider it. But again, like the standard really truly is a Delaware corporation. That's probably 95% of these. And to a certain extent, like as exciting as I am, or I try to be, the goal of and the goal for me when I'm working with you is not for your books, your corporate books and records to be exciting. You want them to be plain vanilla. Investors can understand it. Their lawyers can understand it. It's not going to take a lot of cycles and thinking as they move through diligence. They'll be able to focus on making the investment in your company. Oh, super. All right. Question about why is there a trend towards why is there a trend towards convertible notes instead of safes? I would actually flip that and say that there's a trend towards safes and not convertible notes. What's driving that is there's no maturity date and there's no interest rate. And so from a company's perspective, it's very attractive because I can't tell you the number of times we start, clients start bumping up against the maturity date, and then everyone's kind of nervous. And then the question is, do we do that? Do we not do that? Like, do we go out and affirmatively seek an amendment, or do we just kind of let it sit until somebody tries to call it? And so it just injects a lot of uncertainty. From an investor's perspective, they love having the debt, gives them more control. So I certainly can understand and appreciate that. But I think what's really tipping it is no date, no off the cuff. This is my answer. No maturity date, no interest rate, relatively standardized terms. Okay. So even though I say we like tweak some things in safes, that's true, but it's not like the unstandard terms that are in convertible notes. And so I think all those things, as you know, this early stage financing area becomes more and more standardized. That's what's driving it. I hope that answers your question. What are the tax implications of a capital raised via the founder via SAFE or a loan? So I will tell you the tax implications of having a SAFE are up for debate by tax attorneys, of which I am not a tax attorney. You know, one of the things that you know you need to work with your tax advisor, whether it's a CPA or a tax attorney, on the loan aspect. Typically you may only need to pay interest on the tax on the interest of the loan. So you kind of get the principal back. But again, like a SAFE, like, you know, the SAFE, you're not getting your money, you know, if all goes well, even if all goes well, you're not getting you're not getting liquid on that SAFE until 5 years, 7 years, maybe even 10 years later. Now, theoretically, it's going to have 10x, 12x, 30x. If all goes well. But if you were to do like a note, you know, there's potentially an opportunity, especially if there's not a huge amount of money, right? So like if we're talking about a $10,000, $20,000, $25,000 note, maybe even higher, maybe even up to the six figures, although probably towards the lower end, you know, you may get that principal back a lot sooner. I mean, maybe in a year, maybe in 2 years, maybe in 3 years. Sort of depends on when you think your investors will tolerate you having the note repaid by the company. And if there is no interest rate on it, remember there's the sort of imputation of tax or imputed interest rate that you get taxed on. So I hope that, again, I'm going to totally dodge a tax question because I'm not a tax attorney. But I hope that gives you a little bit of a framework for what the economics are, both from a sort of business standpoint, right? Talking about time horizon of 7-10 years if it's a SAFE before you get liquid, versus a bit quicker if you get that. Oh, there we go. All right. Question is like, does the company get taxed on the loan? Again, I would sort of defer to a tax attorney or CPA to review that particular loan documentation, but usually there's not like tax on the loan. Usually there's not tax on the loan, at least the principal. What kind of clients do I like to work with? Wow, what a softball ones. The kind that ask these types of questions. No, I mean, I love working with energetic entrepreneurs. I love working in, you know, I work in a number of different verticals, or I've experienced a number of different verticals. I'm particularly focused on climate and energy at this point, as well as a number of life science and health. And actually I've got a fintech panel coming up next week. So, those are kind of areas that I'm particularly focused on, although I do have experience working with AI companies, related machine learning, autonomous vehicles, diagnostics companies, CPG, that is consumer packaged goods, lots of different things. The nice thing is like my area of expertise is venture capital. And so I know the industry pretty well, and I understand what those companies need to grow and scale. So thank you. All right. I see a question that I would be happy to kind of follow up via email. So if you want to send me an email, I'll take that one. And probably put in a bunch of caveats, but I can give you a sense for that. All right. Any other, and it's not a legal question, but it's just sort of a landscape question. All right. Any questions or comments or anything further? Going once, going twice. I know I want to be respectful given that you could be feverishly typing, but maybe not. All right. Well, thank you very much for attending either live or on a time shifted basis. I want to thank Idea to IPO for organizing. I want to thank my law firm, K&L Gates, for being a fantastic law firm and for also sponsoring today's program. I want to thank, I think that's it actually, everybody. So with that in mind, again, thank you for your time. I'm going to let you get back to building your great companies. Have a great good night, morning, afternoon, wherever you are. And I will be following up with the recording within about a week or so. Thanks a lot. Take care. Bye-bye.